Everybody, we will get started here momentarily. Please hang tight and we'll start shortly. Hey, good morning, everybody. Thank you for joining the ACA Small Business Bootcamp and Resource Collective for this Tuesday, June 22nd. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority, and we're glad to have you with us today for this bootcamp. I was just talking with a colleague this morning. Can't believe how fast time is flying by and that we're already this far along in June. But we continue to do the boot camp, so we enjoy doing these and bringing this content to everybody. We'd like to first start by thanking all of our community partners. We could not do these boot camp sessions without them. They spend a lot of time, bring an effort, and bring their expertise to these boot camps, and it's what makes it great. So, Small Business Bootcamp and Resource Collective is designed to help small businesses work through the COVID crisis, come back stronger than ever. It is a statewide initiative supported by our community partners. And not only is it the bootcamp webinars, it is a resource collective and a content library. So the resource collective part of it is on our website. And on there, it's about the middle of the website. The top part of the website is the current and upcoming bootcamp sessions. In the middle part, you have our resource collective. And it's got a link to the tools and guides and resources brought by our community partners to help support small businesses. We touch on just about every industry, major industry that is there, things from construction to cosmetology, manufacturing and retail and restaurants and more. So it's a lot of great information on the resource collective. Additionally, with the Small Business Bootcamp, we are in our 58th week. We have a ton of presentations that we've done in the last year. And with that, we have a collection of over 140 webinars that have been recorded. We record all of our webinars. So today's session will be recorded and posted on the website as well. But what that has created is a massive content library. Again, over 140 webinars and presentations and the slide decks that go with them. And it's an opportunity for you to look back at those and review ones that you may have missed that you wanted to attend, or find topics that you want to fresh up on. But we have a ton of information on there, and it's available to everybody at no cost. So definitely check out the content library portion. As you see in the slide deck right over here on the screen, it shows archive. That's where you'll find these recordings. They're archived by week. And you click the little plus button, it opens up and shows you what sessions are in that week. So easy to access, easy to find, and a load of information available to you. Additionally, we have a couple other websites that are very important. The state's COVID information and resource page, arizonatogether.org, a very good website. And then the Arizona Commerce Authority has put together the Arizona Business Resources related to COVID-19 website, azcommerce.com/COVID-19. That is a great website. You'll find business guidance, financial resources, and other great items on that website. Additionally, the ACA has a number of programs to help small businesses as you look to grow and expand. Our Small Business Services, our Workforce Division, and our MEP, Arizona Manufacturing Extension Partnership. These three great programs help support small businesses in a number of different ways. Additionally, if you're looking to start a new business during this time, start a small business, or grow in a different product line or different industry, our Small Business Checklist is a great tool for you. It offers guidance and resources to address the commonly requested licensing, registration, and compliance needs at the local, state, and federal level. There's also a lot of other great information you can find on there to help grow and operate your business. At this point, we'd like to offer a number of updates. These links will be posted in the chat, so I have to try to write it down and search it. The SBA has opened up the targeted advance, the EIDL advance, to eligible businesses. So that's a real important link that, again, we'll post that in the chat so you can go to the SBA's webpage on that. And recently, OSHA has shared some COVID-19 guidance, some updated guidance on that. So it's an important section for the OSHA side of the business. Additionally, we're going to share some links to the IRS Small Business and Self-Employment Tax Center and the SBA's Arizona District Office. So with that, let's take a look at the upcoming sessions. Of course, today we've got Understanding TPT and Online Sales Tax. On Thursday, we have How to Be a Great Boss. And next week, we have Consciously Addressing Unconscious Bias and Demystifying Research and Development R&D Tax Credits. I do want to note on the R&D tax credits, that's going to be a great session because as I was talking to our presenter about it, I had a lot of misconceptions about that tax credit program. And there is an opportunity for Main Street small businesses to take advantage of that. So it's one of those I encourage everybody that's looking for an opportunity for some tax credits to definitely jump on and learn more about that program. So with that, we want to jump into today's speaker. Today we have Melody Haddad. She's from our great partners at Beach Fleischman. She's a tax manager over there. Beach Fleischman has done a number of presentations for us, and Melody's been so grateful to offer her expertise in tax. And so we are going to jump right in and turn the time over to Melody. So Melody, the time is yours.
Hi. Thank you again for having me. So just a little bit about my background. I'm an attorney by training, and I'm with Beach Fleischman, and I have focused my work on state and local taxation. And I'm a tax manager there in our Tucson office, and we have an office up in Phoenix. And so today, if you want to go to the next slide. And I apologize about the technical difficulties. I'm having to join y'all through my phone. My computer decided it doesn't want to work with Zoom today. So luckily we're able to connect. But so further, just to kind of give everyone an idea of the agenda, I'm first gonna go over the transaction privilege tax, since here in Arizona, that's our main focus. And giving a pretty broad overview of kind of how it operates, how the TPT rules and the different moving parts operate within the TPT regime. And then I'm going to focus on a few of the more common areas of business like retail, construction, and commercial leasing. And then after going through, an overview of the TPT, operations in the state, we're going to go over the multi-state sales tax economic nexus since Wayfair, as I'm sure many of you know. So if you want to go ahead and go to the next slide. So when I say TPT, so we're all on the same page, I'm talking about transaction privilege tax. It's commonly known as TPT for short. And it's different than your common, more common sales tax regimes in other states. So most states have a sales and use tax rules, whereas in Arizona, we technically don't have a sales tax. It's a transaction privilege tax, and it's an excise tax for the privilege of doing business in Arizona. So the liability is on the seller rather than on the consumer. So in most states where it's an actual true sales tax, the liability of the tax is on the consumer, and as the seller, you're just doing the service of collecting the tax for the state and remitting it. Whereas here, it's truly the liability of the seller and not the consumer. The seller obviously has the right to pass it on to the consumer. But at the end of the day, whether you collected it or not, you're responsible for it if you're selling something that's taxable and a taxable business activity. So that's something good to keep in mind because it is different than most states. All right. And in Arizona, we have the Arizona Department of Revenue, which is our government agency that administers taxation. And they actually administer it for all levels. So you'll see coming up in a couple of slides, the different components of the tax, because we have a state level tax, a county level tax, and a city level tax. And the Department of Revenue, the state agency, actually administers, so collects and administers the tax for all three levels. So it's supposed to be a centralized, simplified reporting process rather than having to file a return with the city and a return with the state and kind of keep track of filing requirements with different agencies. It's all in one department. And so the incidents. So I mentioned this before, but it's kind of driving it home again, because it is, I think, something good to keep in mind, especially if you're new to TPT or from a different state. It is different. So it's the tax on the seller, and it's different than most other states' sales tax. And so if you want to go to the next slide, the way that TPT operates is that there's different classifications. And there's technically 16 different TPT classifications, and they're based on what your line of business happens to be. And so each of these has its own set of rules. So a deduction under one set of classification may not apply to another one. So you have to really make sure that when you're operating, when you're trying to understand or find what rules apply to your business, you want to make sure you're looking at the right category, because each set has its own set of statutes and rules. So you want to just make sure you're aware of that. And we're going to go into a little more detail on the retail, commercial leasing, and prime contracting, because those are, in my experience, the most common. And then I put asterisks on commercial leasing and prime contracting, because for those two, there's also two city-only level TPT taxes that we'll talk about. So that's why they're asterisks. And so, the way that it works is that if your business falls outside of one of these enumerated business classifications, then you're not subject to TPT. So if you're doing something like, for example, professional services, or most services, unless they're specifically listed in that set of 16 categories, if what you're doing falls outside of those, you're not subject to TPT, and then you don't have to register and file and collect and pay the tax. But if you do, then you're going to have to register and be in compliance through that. So the next thing is about registration. So say you find that what you're doing in your business falls under one of the taxable TPT categories. So you're going to have to register. And of course, you're going to have to pay the tax and file the returns. There's a couple of options for registration, and I've listed the 2 ways that you can really do it. You can do it all online by following that link with the Arizona Department of Revenue's website. And it'll walk you through, you'll have to basically set up an account with their online portal. And so you'll have a username that's linked to, your email and a password. And then after you have a login, you can go in and register a business and go from there. And if you don't want to do it online, there's the paper form, and it's called a joint tax application, and it's AZ form JT-1. And it's a joint tax application because it allows you to register for TPT and withholding and payroll accounts with the Arizona Department of Revenue and DES on the payroll side. So all of that can be done through the one registration process. And if you do it on paper, you can mail it. I believe you can fax it, or you can hand deliver it to the department. And there's fees, of course, for registration. There's a state fee, and then there's a city fee. Hopefully y'all can still hear me because my phone is unfortunately putting calls through. That varies. So when you initially register, you'll pay the state fee and then the city fee based on where your business is located. And then you have to make sure to update and renew your registration annually. So that's something to kind of put on your calendar yearly to make sure that your registration is up to date, because you want to make sure to be in compliance with your registration, not just if you're selling things and need to file and pay tax, but even if you're, say, a wholesaler and you're technically, all your sales are exempt as resale sales. When you're purchasing your products, you want to be able to give an exemption certificate to your vendor. and you need to be in compliance and have a active license in order to do that. So it's always good to make sure your license is up to date. And so filing requirements, if you want to go to the next slide, thank you. Sorry, go back one. Thank you. So TPT filing requirements. So assuming that you're subject to TPT, you're gonna have to file. And how often you have to file really depends on the volume of your activity. And so they've set thresholds for the filing frequency. And so if you're paying, if you assume that you're gonna pay $2,000 or less in annual TPT, then you can just pay once a year, file and pay at the end of the calendar year. If you're paying $2,000 to $8,000 in tax on an annual basis, so over the course of the year, your tax liability is up to $8,000, then you're supposed to file a quarterly. And then if you're more than $8,000 on an annual basis, so over the course of the whole year, your TPT liability is more than $8,000, you're supposed to file monthly. And then they also have the seasonal, which is not very common. But if you're active for 8 months or less, you can elect to file seasonally, and that's its own kind of unique process. But the default is monthly unless you expect to not have that much liability. So that's kind of the filing frequency, like how often you're supposed to file and pay. And then the other thing to keep in mind is how you're supposed to file and pay. Because actually just recently, earlier this year, they lowered the online threshold to $500, which is pretty low. So on an annual basis, if your TPT liability is $500 or more, you're required to file and pay online. And you don't want to mess with that, especially if it's actually significant amount, because the penalties can be very hefty. They're a percentage of the tax owed. And so if you're paying a lot of tax and filing paper returns and paying, with check, your penalties can be pretty significant. So just keep in mind how you're supposed to file, and it's most likely going to be online. So it'll be good to get that online account set up with the state. And I noticed some questions coming through. So if y'all don't mind, I apologize. We're going to just wait till the end so that, because it's hard to see on the phone. And that way we can just address everything at once. So if you want to go to the next slide. So TPT components, like I mentioned earlier, in terms of how the state is now administering all the TPT at all the levels, that's because the reason that's relevant is because there's different components of the TPT. There's a city level, there's a county, and then there's the state. So the state rate currently is 5.6%. And the TPT is, coming from Arizona Revised Statutes and Title 42, Chapter 5, and then you go into the subchapters depending on your business classification. And then there's the county. So if you're within the county, whatever county limits, you're going to also have the rate. I listed just Maricopa and Pima. Those are the kind of two most common. And those are the 0.7 for Maricopa and 0.5 for Pima. And then if you're within a city limits, you're going to also be subject to the city tax, assuming your activity is taxable in the city. And again, I just listed the two most common, Phoenix and Tucson. And so you have 2.3 currently in Phoenix and 2.6 currently in Tucson. And so when, the combined rate is going to be the state, county, and city of whatever your location happens to be. And you report it all on one TPT return that you file with the Department of Revenue. All right. So now I'd like to go into, if you want to go to the next slide, just the more overview of kind of TPT considerations. And the reason I mentioned this, bundle transactions, is because it's something that's often overlooked. And especially if you're doing something, if your business is selling something that is taxable and providing a service at the same time, or vice versa. Providing a service that's taxable and giving some kind of tangible personal product, so some item, some widget that goes into your service that you're providing. This is something to keep in mind. And bundle transactions is basically when you have an item or service sold, a taxable item or service sold with a non-taxable item or service, and you do not separately charge, separately state on your invoice the charges for these two different items. And there's three categories that the state kind of lumps them into. So if you have a non-taxable service, that's the primary object of the transaction, and the taxable property is just incidental to the service that's being provided, then it's not going to be taxable. So a good, a simple example is like a CPA firm. They're preparing your tax return for you. They're providing you a non-taxable service, and say they're also providing you with some sort of log to help with managing your business, and it's like a booklet. So if you buy that in Office Depot, you would pay retail tax on that booklet. But if the primary object of the transaction is this tax advice and accounting service, and this booklet is just an incidental part of that service, then the whole charge won't be taxable. That's also assuming that that the accountant didn't separately state the charge for the service and the booklet. And then if you have a taxable, the second category is a taxable personal property. That's the primary object. And then a non-taxable service that's incidental. Then in that case, the entire charge will be taxable. So if you're selling like a refrigerator, and what someone's really buying is that refrigerator, and you're also offering the service of installing it in their home, and you're not separately stating the charges for the installation and the refrigerator, what they're really buying is that refrigerator. And if you don't separately state it, then all the charges is going to be taxable. And so that's why it's really good to separately state. The third category is when you're selling something that is really distinct and separate from each other. And then in that case, you're supposed to charge tax on what's taxable, and you don't have to charge tax on what's exempt. So we're going to go to the next slide. There's two main approaches that the state has, and it's the dominant purpose test, which was kind of part of what we went through the exercise on the last slide, where you're looking at what's the dominant purpose of this transaction, like what is this consumer really buying from you? And then there's also a de minimis percentage. So there's a 15% threshold, where if the component that's so let me back up. So if you're selling something that's not taxable, whether it's a service or a product that's just not subject to TPT, and you're also selling something, the transaction also includes something that is taxable. If that component that is taxable, if its value, so what you purchased it for, is less than 15% of what you're selling it for now, what the transaction is, then the entire transaction can be exempt. But if what your purchase was more than 15%, then the whole transaction is supposed to be taxed, if that makes sense. And we can go over questions about that at the end if y'all want. So let's go ahead and kind of dive into the retail TPT. So as I was mentioning, there's different classifications, and when you report, you have to list the classification that you're reporting under. So for retail, it's 016. So we'll put that there. And generally, it's involves selling tangible personal property at retail. And it's good to keep in mind that in Arizona, TPP, so when I say TPP, I'm talking about tangible personal property, not to be confused with TPT. So TPP includes not just physical widgets that, like a computer, but also anything that can be seen, weighed, measured, felt, touched, or in any way perceived by the senses. So what that means is things like intangibles, like software and software as a service, those get captured by the retail TPT. And in terms of when the TPT can be triggered in terms of a sale, it's any transfer of title or possession of the product. And the tax base under the retail TPT is the gross revenue from the business. So the reason to keep that in mind, if you want to go into the next slide, is that even if you have deductions that you can take, or if you believe that, so say you're a wholesaler, and all your sales are sales for resale. So whoever you're selling to is going to take it and resell it. And you're the wholesaler in this scenario, you're still supposed to report. So you report your gross revenue, and then you take a deduction for the sales for resale deduction, which is deduction code 503. And then you get a taxable revenue amount of 0 at the end after you go through that exercise. But it's not like you get to, just report 0 returns. Technically, you're supposed to report your gross and then apply whatever deductions can apply to your situation. And so the common deduction that I was just talking about is the sales for resale. And the other thing to keep in mind is that if you recall that the incidence of the tax for TPT is on the seller. So when you have someone coming to you and saying, hey, or even if you know this person and they have a shop that they're going to take your product and sell it in, you're under the obligation to collect a resale exemption certificate from them. Because if your business were to ever get audited, if you don't have record of the exemption certificate, that revenue is going to be deemed taxable because the state doesn't have proof that it was exempt. And so I put a link for the form, and it's Arizona Form 5000A, and that's just a simple resale exemption certificate for Arizona. And so the buyer gives it to the seller, and the seller keeps it in their record. The other thing, the other common exemption, technically deduction, is out-of-state sales. So in retail, so you have a shop in Arizona and you also have a website, or however people can connect with your business, doesn't have to be a website. And you have a shop here in Arizona and your inventory is here in Arizona, for example, and you get an order from someone in California, and the customer is clearly located in California. Their billing address, their deliver to address is in California. That transaction can be deducted. So you're included in your gross revenue for that, say you're on monthly for that month. And you take a deduction now 504 for out-of-state sales. And you need to, so in case you ever get audited, the kind of record keeping that you want to have is proof that the order came from out of state. So this customer wasn't physically present in your store. They either called on the phone or placed the order online, and they're located in whatever state that's not Arizona, and that the delivered to address was outside Arizona. So just keep track of your records for that purpose. So those are the two most common deductions under retail. And then I wanted to kind of go over some misconceptions, if you want to go to the next slide. And I went into this a little bit already, the first one, which is that a wholesaler, some folks think that I'm a wholesaler, I don't need to deal with TPT because all my sales are for resale. That's somewhat true, and that you're not going to have to pay TPT on your sales, but you still have to file, and you're still supposed to keep a record of your exemption certificates. So just because you're a wholesaler or your sales are for wholesale doesn't mean you just can forget about the TPT, unfortunately. And then the other common misconception that I see a lot is a lot of people think that if a transaction involves a nonprofit, then we can forget about the TPT, and that's not the case, unfortunately. There's very limited exceptions for transactions involving nonprofit organizations. And so I listed them here in general terms. And so if I italicized by, so a sale by a 501c3 nonprofit that exclusively operates for charitable purposes and serves meals at no cost. So those are also part of the requirements in this case, are exempt. So if the 501c3 nonprofit is making the retail sale, that transaction is exempt. And then there's also an exemption for 501c6 nonprofits. When they are the seller, then that could be exempt. The most common question in this area that I get is when the sale is to a nonprofit organization. Unfortunately, it's a misconception on both ends. The sellers and the nonprofit itself a lot of times assumes that they're exempt from TPT when they are the purchaser, but that's not the case. Unless some other exemption can apply. So if they're buying it for resale, or it's for out of state, or some other kind of exemption can apply, that sale to the nonprofit is going to be taxable. And then, so I think this wraps up what I wanted to go over for retail TPT. And now I want to switch gears to commercial leasing TPT. And so the business classification where this revenue would be reported is 013. And this is a city level tax only. And it applies to the business of leasing real property used by the lessee for commercial purposes. So you're looking at office spaces, shops, things like that. And again, this is a city only level tax. And the tax base is the gross revenue received by the lessor. And one of the misconceptions I actually see in this area is that a lot of times the landlord, so the person receiving sorry, my phone's for some reason gonna die. So let me just plug it in. A lot of times landlords think that only the amounts received for actual rents is subject to the commercial lease TPT, but that's not the case. Essentially everything. So if your tenant is giving you amounts for property tax reimbursements, for insurance, maintenance fees, improvements, all of that is going to be subject to the commercial lease TPT. The one thing it does exclude is actual utility service reimbursements. So the exact amount, so say the landlord pays the water bills and you charge your tenant for it, if it's the true amount that you're being reimbursed for utility service, that can be exempt from the commercial lease TPT, but otherwise any amounts, any money is paid to the landlord from the tenant are going to be assumed taxable. There are a few exemptions, and the most common are the related party exemptions, where if the landlord and the tenant have 80% common ownership, or there's a family relationship, immediate family relation between the landlord and the tenant, like a father-son or mother-daughter, or etc., that would be exempt. But again, a licensing may be required still if you're receiving revenues, and then you can just take the deduction. So the other leasing TPT I wanted to cover is residential leasing TPT, and that has its own classification of 045. So rents received for this activity would be reported under the 045 TPT classification. And again, this is a city level tax only, so no state or county rate would apply. And I listed the cities that do not have this. So if the city's on this list, like Tucson, then it does not have the residential leasing TPT, but every other city will have it. There are exemptions. A lot of cities have exemptions, like if you're only subject to it if you have 3 or more residential properties for rent or something like that. But otherwise, if you have a residential rental property in a city not on this list, you want to keep in mind this TPT. So the next category of TPT I wanted to talk about is prime contracting. It's one of the most common areas that I see issues with for businesses that operate under this TPT classification, because the rules are so convoluted or can be. So generally speaking, the prime contracting TPT involves the business of prime contracting and manufactured building dealers, actually, and essentially covers any contracting changes to real property. However, as of 1/1 of 2019, it does not include work when the contractor essentially is actually not required to be licensed by the Registry of Contractors. So if you're having a job performed by someone who's not required to be a licensed contractor, then that wouldn't fall under this. And there's 2 main categories. There's modification and what's called MRRA, which we'll go into. And the tax base, again, is the gross revenue. So all the revenues received unless deductions apply. And so let's go to the next slide. So we'll start with talking about modification. So modification is construction activity that is taxable. So modification projects are subject to the prime contracting TPT. And it involves like any ground up construction, so grading, leveling, wreckage, demolition, and any new build activities. And essentially anything that cannot be qualified as MRRA, which we'll go into. And another thing to keep in mind is that under the prime contracting TPT, only the GC, so the general contractor's revenues, are going to be subject to the TPT. So if there's subcontractors involved, in order for the tax to only fall on the GC, the subcontractors are supposed to receive exemption certificates, and specifically Form 5005 from the GC. So the GC issues 5005 to the sub so that the sub doesn't collect the TPT from the GC. Otherwise, if the sub doesn't receive this, technically they're liable for tax themselves, and so should collect it from the GC. And the other thing to note under prime contracting is that materials incorporated into a taxable project are exempt from retail TPT. So when a contractor is buying materials like wood, for example, and nails, and whatever materials they're going to incorporate into the project, they can issue an exemption certificate to the vendor that they're buying the materials from, so that they're not charged the retail TPT. So that's modification broadly. So the second main category is commonly called MRRA or MRRA, and that stands for maintenance, repair, replacement, and alteration. And those activities are not taxable. So the way that it works is technically that they're supposed to be reported and then deducted under the MRRA deduction code, but it's not taxable under the prime contracting. And so in order to qualify for a MRRA, your activity has to fall into one of these 4 categories. So maintenance is upkeep of an existing property. So, hiring someone to take care of landscaping and kind of, any maintenance activities on the property. Repair is returning the existing property to its usable state. So repairing a roof, for example. So if you have a hire a contract to repair your roof, that should be exempt under MRA. Replacement is removal of existing property and replacing it with the same or upgraded version of the same kind of property. So like a window, for example, if you hire a contractor to replace your windows in the house, that should be exempt as MRA activity. Alteration, on the other hand, is kind of the catch-all. So if you don't fall into maintenance, repair, replacement, you want to see if you fall into alteration, because it's can be very broad with the threshold limitations. And it's any direct physical change to an existing property, as long as the contract amount is below these thresholds. And there's different thresholds depending on the type of property. So if it's a commercial property, the contract has to be less than $750,000. And if it's a residential property, the contract amount has to be less than 25% of the property's full cash value. And that's the full cash value based on the county assessor's valuation that you would get for the year that applies to when the contract is taking place. And so that's pretty broad, because it doesn't have to be replacement, it doesn't have to be repair, it doesn't have to be maintenance. As long as it's below these thresholds, it can be alteration potentially and exempt from the prime contracting TPT. So alteration is, usually the go-to if it's not obviously one of the three. And if you can, fall under the thresholds, then, you're not going to be subject to the prime contracting TPT. And if that's the case, if you are working under MRA, your purchases are going to be taxable. So whereas a prime contractor who is working on a job that is taxable under the prime contracting, that kind of situation allows them to purchase materials exempt from retail TPT. On the other hand here, if you're operating under MRA and your revenue is exempt, then your purchase of materials is going to be taxable. So you don't get to buy materials exempt. And then I think this is the last one in this category, yes. Speculative Builder TPT, commonly called Spec Builder TPT. This is also city level, like the commercial lease and the residential lease. Spec Builder TPT is a city level tax only, and it's one that is commonly overlooked because it's uncommon. Most states don't have this. And if you happen to go into a project like this that falls under these activities, and this isn't your common, everyday 10-year long career, you might not be aware of this, but it's out there. And the tax base is significant. It's the gross income derived from the sale. So it's a tax on the sale of improved real property by a speculative builder. And so if you buy a piece of land, you build an office building on it and you sell it, as long as you're within the parameters of these rules. So for commercial buildings, there's actually a timing consideration, because if you sell the building after 24 months of substantial completion, then you can escape the tax potentially, but sometimes it's not worth waiting that long. Tax isn't the only consideration to think about when you're making business decisions. It's an important one, but it's not everything. If you sell within 24 months, the gross amount, so like the sale price of the property on your closing statement, say it's $2 million, you're going to owe the spec builder tax on that $2 million. And the rates vary by city, and it can add up. Even if it's not in a sale in the millions of dollars, if it's $100,000 or however much, if it's not exempt, then you want to keep in mind when you're deciding on the sale price that you want to have, because you're going to have this out-of-pocket sort of expense after your sale. And so I mentioned the 24-month window for commercial properties, there is no time limitation or threshold for residential. So residential property could be sold anytime, as long as it's sold by a spec builder, which is basically someone who's not falling under the family residence exemption. That sale of the residential property will be subject to the spec builder TPT. So that's the tax, but then there's, of course, the family residence exception. So if you build a house and you occupy it as your primary residence with your family, and then you sell it however long after that, as long as you like genuinely used it as your family primary residence, that sale that you make will not be subject to the spec builder TPT. There's some additional constraints also in terms of how often you do this. So you want to keep in mind and make sure to look into that exemption in more detail to, you know, just be aware of your exposure if you're, you know, doing something like this. So can be significant. There's of course deductions, like any of the other classifications. The most common deduction is the 35%. So your starting point is your gross. So you start with your gross sale price, and then you take all the deductions that apply. And that includes the 35% deduction, so 35% of the taxable amount. And there's deductions for tax that you've paid to the contractors on the job as you work on building that property. There's deduction for engineering and architecture fees. There's deduction for development fees. So there's a number of different deductions that you can take to reduce the taxable amount. But, you know, at the end of the day, it's a tax that you want to keep in mind and be aware of all the rules that apply to your case. So that's a spec builder TPT. It's, you know, one that gets a lot of people off guard, unfortunately. So now if you want to go to the next slide, before switching gears to multi-state economic nexus, I wanted to share some TPT resources. So first I put some resources coming directly from the Department of Revenue's website. So there's the link for rate tables, because rates change periodically, and you want to make sure and also if you want to look at a back period, so say you realize, you know, 16 months ago you didn't file a return, you can go and they have an archive of the rates, rate tables going back many years. So if you go to that link, it'll show you the current rates table, and then it has the archive of all past months. And then this middle one is actually a really handy tool. It's an online rate lookup. And on that link, if you go to it, you can actually put the address of the transaction. And if you do you mind if we do that real quick? I think we have time. Oh, we're actually running out of time. Well, the resources are there. And I'm happy to answer questions through email if y'all want to contact me. So maybe let's switch gears. I'm sorry, I've lost track of time. Sales Tax Nexus for the multi-state now portion of today. And so prior to Wayfair, we had only physical presence was the only way you could trigger Nexus, which is pretty simple. Do you have property or people in a state? If yes, you're subject to sales tax in that state. And then Wayfair kind of changed everything. So back in 2018, South Dakota versus Wayfair was a Supreme Court case that changed the rules for sales tax nexus. If you want to go to the next slide. And it involved an online retailer, I'm sure you're familiar with Wayfair, who didn't have a physical presence in the taxing state, but had significant sales into the taxing state. And South Dakota, typo, is a member of the Streamlined Sales Tax Network, which I'll loop back to later if you want to go to the next slide. So sales tax economic nexus is what has come out of Wayfair. And so since 2018, almost every state has now enacted some kind of economic presence for sales tax nexus. And the threshold coming out of Wayfair was $100,000 of sales, and this is all annual. So annually, $100,000 of sales or 200 transactions or more. So that's the minimum. The state, and no state can set a lower threshold. So a state can't have $50,000 of sale because that's the lowest bar based on Wayfair. And then, you know, factor are not streamlined sales tax agreement signatory states. So South Dakota, the case that established this kind of taxing authority, was in a state that was a streamlined sales tax agreement signatory state. And that's relevant in terms of the ease of administration and compliance on the business. So sales tax economic nexus is in every state except these. And of these 5 states, 3 of them don't even have sales tax. So the only ones that don't yet have economic nexus are Missouri and Montana. So I have no doubt they'll enact some sort of economic nexus provisions, but they haven't done so at this time. So every other state is going to have economic nexus, where if you're exceeding the state's threshold on an annual basis, then you're going to be subject to sales tax, even if you have no physical presence in that state. So as an Arizona business, if you're selling into a number of states at high volume, so exceeding at least the state's threshold amount, you're going to be subject to sales tax, even though, you know, your shop is here in Arizona. You're not touching that other state besides just mailing your products there. And the next slide is the resources I wanted to share for multi-state sales tax. And the first one is a link to the Streamlined. Can we go there real quick? Do we have time? We have a couple minutes. Let's go there so I can show folks what to do with that. Okay, so this is the homepage to the Streamlined Sales Tax Governing Board, and they're in theory a neutral third party that functions to streamline sales tax compliance for businesses across the states. So they're not affiliated with any state. However, the way that it works is that a state can sign on to be a member, and by doing so receives benefits of the Streamlined Sales Tax Board's compliance options. And if you go to the link for businesses towards the top, and then marketplace seller, so third option down. Okay, so this is, go down. Sorry, I took you to the wrong page. Let's go. It was for business, and then, sorry, remote seller. So go to remote seller, the second one down, and then remote seller state guidance, the top one, yeah. Okay, so this is gonna give you, in theory, a up-to-date chart of every state's sales tax nexus rule for economic nexus. So it tells you the effective date of when that state started having economic nexus for sales tax, and then it'll tell you the threshold amount. So if you want to look at Arizona, for example, not that it's relevant necessarily for any of us on the webinar right now, since I assume we're all here in Arizona, but just to keep in mind, it's now currently $100,000 in Arizona. Most states have the $100,000 threshold, which is relatively low, can be met. But some states have much higher. So California has a $500,000 threshold. Texas is another one with a high threshold of $500,000. But almost every other state has the $100,000 threshold. So this is a link for you all to, the hope in sharing it is that it is something that can be useful to you. And, it allows you to have access to the resources offered by the Streamlined Sales Tax Board. And so, if you're looking at this and you realize you're exceeding thresholds in some of these states, at that point you have a business decision to make in terms of what do you want to do with that, because if a state were ever to audit you, if you ever come under their radar, you're going to have to pay that tax out of pocket if you haven't been collecting it from your customers. And so if you find that you have nexus in some of these states, the next step is making that decision of, do you want to be in compliance, or do you want to take the risk of staying under the radar and hope the state never catches on? And if you do want to be in compliance, the next step is determining kind of what to do from there. And you have to have some sort of like plan for your business in terms of the states that you're choosing to register in and how you're going to stay in compliance, because it can be pretty burdensome to keep track of sales tax returns and all the changing rates. Every state, just like us, has local level rates that vary. And so you're going to probably need some input from resources that can offer support to your business and being in compliance in that way. I'm a state and local tax specialist, so you're welcome to contact me with questions about this area. And then there's also, once you've determined kind of what you want to do, there's softwares that help you to stay up to date on the rates, and also can handle your filing. So the most common one, and that I see, and I have no affiliation, there's no benefit to me if anyone uses it, but it's called Avalara is the business. And I linked their website so you can check it out. There's a few other companies that do the same thing that Avalara does. In my experiences, businesses have the least issues with Avalara. They're not perfect, but I see the least issues with them. But they would be able to sync into your software or website and apply the rate, the correct rate, in real time to the transaction that is taxable, and can also handle filing the returns with the states for you. And I put down voluntary disclosure, and I apologize, we're running out of time, because if you find that you have back period exposure and you do want to come into compliance, voluntary disclosure is a good way to do it, because it eliminates penalties. It limits look back periods, but since we're only going back to 2018 at the most, and presumably, that might not be so relevant, but that's always a good thing to keep in mind as an option to be in true compliance. So I apologize for running late.
Excellent. Thank you, Melody. Great information. We have a number of questions, probably more than we have time for. I know we have more questions we have time for, but there's a few simple ones that I want to kind of go through because they're questions that we hear a lot.
Sure.
The first one I want to touch on is from Kevin, and it's a great question because I do hear this a lot. It says, where does photography fit in taxable activities, especially those who are not selling any tangible finished products, i.e. prints, canvas, framing, etc.?
So it's a sale. My understanding is like a digital photograph that's being delivered electronically, right? Is that what you're taking away? Yeah, it really depends on the state's rules, and I hate to be giving that kind of answer of it depends, but it really does, because every state has their own definition. So like I mentioned, Arizona, so that would fall under Arizona's TPP because it's perceived by the senses. It's something you can visually see. There are some states do have exceptions for photography and other kind of items, but it really depends on each state's definition of tangible personal property. And more states are capturing digital goods because, of the way that the things are moving in the world. But if a state strictly has a tangible personal product as something you can, just physically hold, then that could fall outside of it. But otherwise, it would be subject to retail.
So essentially, if a photographer was using their own camera, taking pictures for somebody, there's going to be something taxable because they're given the pictures at some point. If
So
there's to
like
be
a
service
like
only,
a wedding. Yeah. So
yeah.
there's a difference between a service and the digital goods. So if it's a custom, like if it's, there's also usually exceptions for custom items, especially under the intangibles. And so if it's like a wedding photographer, for example, that's very custom, you know, no one else is going to be buying those products, that would potentially be exempt. But to be honest, I've never looked into, you know, this idea of like custom photography. I'm happy to, if Kevin's contact info is there, I can shoot him an email.
You can send over to me and I'll get it to him.
Okay, sounds good.
So let's go. We got we're running a little long, but I do want to ask one more question. I gotta find it. I saw it in here. This is a simple one, but it says, I opened my business in March. Do I only pay the liability for March through June?
So you're supposed to, if your business activity falls under one of the taxable TPT classifications, you should have registered for a TPT license back in March. Better late than never, so go ahead and do it. Yeah, you would file every period that you're in business. So, you know, at this point you have March, April, May, June. And for filing frequencies, you know, you file by the end, if you're doing it online, of the following month. So once June is over, it'll be due online by the end of July. But yeah, you would be subject only for the periods that you're operating, or since your start of business date, if that makes sense.
Okay. And then one last question. It's a retail online sales. So we had a couple questions come in through from Bob, and he was asking about drop shippers, and then he kind of specified, I believe he's selling shirts, hats, water bottles, etc., and using a drop shipper as his vendor, his wholesaler. So would he be paying the sales tax on those?
In almost every state, the drop ship rules basically call for the ultimate vendor. So I'm sorry, Bob, you said was the name? Yeah. To collect the tax, and they're supposed to have an exemption certificate between them and the drop shipper.
Okay.
So the transaction of the sale from Bob to his customer is the amount that's going to be taxable.
All right, excellent. Well, thank you. We have run out of time. We've gone a little bit over, but we want to get a few of those questions. Melody, I will send you the list of the questions, and that way you can, and with the emails, and you may be able to contact them directly with some answers for those that participated. But we want to thank everybody for being here. We want to thank Melody for her time and effort on this. It's much appreciated. We hope everybody has a great day. We look forward to seeing you on Thursday morning at 9 a.m. for our next boot camp. Until then, enjoy the day. Thank you.
Thank you all so much. Take care.